Hi, my name is Christian Waldegrave, Head of Research at Teekay, and this is our conventional tanker market update for November 2015. Well, when we spoke to you last month, rates were just starting to come up after a fairly weak August and September, and it was really being led by the VLCCs. And we saw that continue during October. In fact, by mid-October, we saw VLCC rates about $100,000 per day, which was the first time that they'd hit that 100,000 mark since 2008. And that strength in the VLCCs was really being driven by very strong imports into Asia, particularly into China. And we also saw a very high level of exports from typical VLCC load regions such as the Middle East. We had record high exports from southern Iraq. We also saw a lot of Atlantic basin crude moving east from places like West Africa, and also a few North Sea cargoes moving to Asia, which is obviously very long ton miles and created a lot of demand for VLCCs. However, we did see that the Aframaxes and the Suezmaxes initially lagged the VLCCs, but just in the last week or two we've started to see those rates come up as well. And at the time of doing this video, Aframaxes in the Atlantic are earning about $35,000 to $40,000 per day, and the Suezmaxes are up about $50,000 per day. And that's because we're starting to see the refineries in Europe come out of maintenance, and that's quite important for Aframax and Suezmax demand because Europe's a big discharge area for those vessels. We've also seen a big increase in Russian exports out of the Black Sea and the Mediterranean, and again that's positive for Aframaxes and Suezmaxes. And what we're also starting to see now is some of those seasonal factors coming in, some of the weather delays. We've had some bad weather in East Coast Mexico which caused some vessel delays, and we're starting to see a few delays through the Turkish Straits now. Delays there have got up to about 3 to 4 days in each direction, so that helps to tighten tonnage supply and gives support to rates. And what we're also seeing going into winter is not only will we get these weather delays, but we're also getting these port delays and ullage delays, really caused by the fact that global oil inventories onshore are so high. So if you think about the last year, global oil supply has far exceeded global demand, and that means that crude and products have been building up in inventories. And so that means that when ships get to port, sometimes the infrastructure is not there, that the tanks are full, and that's causing some discharge delays. And we've seen that in various places over the last couple of months. In China, we've had some vessel delays. On the distillate side, we've had some delays in Northwest Europe. And in the past few months, we've also seen fuel oil delays in Singapore and some ullage in US Gulf as well. And so when we look towards the winter market ahead of us, the rest of Q4 and into Q1, we think it's going to be a really firm market because not only are the fundamentals good, we still have low oil prices at $50 per barrel or lower. We still have very strong oil demand, fairly limited fleet growth. But I think some of these seasonal factors and some of these ullage delays and port delays will also add a bit of froth on top of the strong fundamentals. And so we think that during the winter, especially when you get into December and January, we might see some very spiky markets, some very volatile freight rates, and that's what's going to drag up the global average shipping rates. So we're really looking forward to a strong winter market. And then moving into 2016, we think that 2016 again will be another good market for tankers. Much of the fundamentals that we've seen from 2015 will carry on through to next year. We think that oil prices will stay fairly low for the most part. We don't see much change in OPEC policy next year, so we should continue to see very strong OPEC oil production. We have the possibility of Iranian production coming back in 2016. Sanctions will probably get lifted sometime towards the end of Q2, and so we should start to see more Iranian barrels flowing in. And US oil production is proving quite resistant as well. And so we think that there's going to be continued strong oil supply, and that will cause oil prices to remain low, which of course is good for tanker demand and for tanker rates. There are some concerns towards the back end of the year. The fleet growth does start to increase a bit. It's quite a big delivery schedule for VLCCs and Suezmaxes. But as I said, that is more weighted towards the back end of the year, which could cause a bit of softness going into the late part of 2016. But on a whole, we think that 2016 is going to prove to be another very firm year for tanker rates. So that's our conventional tanker update for November, and we'll speak to you again next month.